Very good afternoon, viewers. Welcome to today's session. I am Dr. Neha, Seth, working in the capacity of Associate Professor at School of Management Studies, Indira Gandhi National Open University. And in today's session, I'm going to cover about fundamentals of financial management. So before starting the session, I would like to talk a little about this famous personality. This person is Mr. Warren Buffett. He is the famous American investor who is known for his successful investment in undervalued companies. He is CEO of Berkshire Hathaway, the company with the most expensive share in the world. And he has given many philosophies of finance. One of his sayings includes that rule number 1, which says that never lose money. Then rule number 2, never forget rule number 1. With this kind of mindset, he is now a renowned personality in the area of finance. And from his teaching, we are going to discuss the topics that I'm going to cover today. And the topics will include nature of finance, relationship of finance with other management functions, changing role of financial manager, and focus on shareholders' wealth maximization. We will see that how the focus is shifted from profit maximization to maximizing shareholders' wealth. Starting with this term finance. Finance, it matters more than what we may realize. It is like a lifeblood for any individual or any business. Like we have blood in our body, in every corner of our body is functioning because of the blood which is running in our body. Similarly, finance is also like the blood which is running any kind of business. In fact, any individual's day-to-day working is possible only when he is having the sufficient finance with him. Finance may also be defined as an art and science of managing money. Why finance is known as art? Finance is known as art because it includes some kind of experience, some anticipations, some kind of intuitions at times for taking some decisions. At the same time, finance is known as science. Why? Because we need different formulas, we need different kind of theories, models, which needs to be applied while dealing with finance so that the right decision may be taken to reach some particular decision specifically for any kind of company. So that is why we may say that finance may also be defined as an art or as science. Coming to the definition of financial management, before discussing the definition of financial management, I would like to mention that what do we understand by the term management? So management is nothing but it is like planning, controlling, organizing the things all together. So when we are doing these functions for finance, this is called financial management. So from this perspective, this definition of financial management is drawn, which says that financial management is the managerial activity which is concerned with the planning and controlling of firm's financial resources. That means we are managing the financial resources of the company when we are dealing in financial management. Financial management is also concerned with the duties of financial manager in a business firm. So what all duties a financial manager is performing in a business firm is also known as financial management. Before moving ahead, I would like to talk briefly about different types of assets. We have real assets and we have financial assets. Okay, real assets are classified as tangible assets and intangible assets. Tangible assets can be building, machinery, etc., while intangible assets include goodwill, patents, copyrights, etc. Whereas, on the other hand, we have financial assets. These are not classified as tangible or intangible assets, whereas these are classified as equity or debt. We also call these financial assets as securities. These are known as financial papers or maybe different type of instruments. Examples of financial instruments are shares and debentures. Why I have specifically mentioned about these assets here? Because the focus of financial management will be on financial assets. So before moving ahead, I believe that we should understand what are financial assets. So financial assets are basically securities, or it may be also known as financial papers or instruments which are classified as equity or debt, or shares or debentures. Okay. Now what are shares? Shares are something that represents ownership rights to their holders. Shareholders are like the owner of the company. When somebody invested in a company or somebody brought the share of the company, that means the person has invested in that company and now he is acting as the owner of the company. Examples of shares may be preference shares and equity shares. Similarly, we have debt and loans. Okay, these debt or loans represents the liability of the firm toward outsiders. Lenders are not the owners of the company, just like shareholders. They are the one who have given loan to the company. Since they have given loan to the company, so they have right to get interest. Okay, so when we have raised the money in the form of debt or loan, we need to pay interest. Now coming back to our subject, finance and financial management, and how this finance is related to other management functions. So all business activities involves acquisition and use of funds, be it any activity related to management. We may talk about production and operations, human resource management, marketing management. Financial policies are devised in such a way so that it will get fit into the management decisions of a firm in practice. Okay, so basically for all the segments of management, we need finance. Okay. Now, finance and financial functions or financial decisions. Okay. So when we are talking about financial management, this subject in itself is dependent on 4 types of decisions. One is financing decisions, investment decisions, dividend decisions, and liquidity decisions. These 4 decisions are classified as long-term decisions, or we may also call them long-term financial decisions or short-term financial decisions. Long-term financial decisions include financing decision. That means from where we are going to raise the funds. Okay, what will be the sources of fund? At what rate we are going to raise the funds? These are also known as capital structure decision, capital mix decisions, or leverage decisions. Then the second one we have is investment decisions. So once we have those funds for the business, where we are supposed to invest those funds. So what would be our asset mix? Okay. So these decisions are also known as capital budgeting decisions or long-term asset mix decisions. The third long-term financial decision is dividend decision. Now we have invested our funds into different type of assets. Our business is functioning properly and we have started earning profit as well. Now, what we need to do with our profit? Shall we give this profit back to our shareholders in the form of dividend, or should we keep this profit with ourselves and reinvest in the company for the purpose of growth? So we need to take decision at this moment as well. And this kind of decision that we need to take is known as dividend decision. Okay, or we may also call it profit allocation decision. These are long-term financial decisions. Because once these type of decisions are taken, the impact will be seen for number of years to come. The impact will be seen for long term. Okay. So, and also once these kind of decisions are taken, it is difficult to reverse these decisions. And even if we are in a position that we are able to reverse these decisions, we need to pay substantial cost for reversing these decisions. Okay, so that is why these are known as long-term financial decision, and of course one of the most difficult decisions to take when it comes to finance. Then we have one short-term financial decision as well, that is liquidity decision. That means how much amount we need to maintain in the form of liquid cash or in the form of liquid current assets, so that the day-to-day functioning of our business will not get impacted. These kind of decisions are also known as working capital management or working capital decisions or short-term asset mix decisions. Okay. So this was about the finance functions, or we may call them financial decisions. Now, financial management and how it is related to other disciplines of management. So we have certain primary disciplines that we started or we have studied before studying financial management, like accounting, macroeconomics, microeconomics. So these are certain basic or primary disciplines. Whereas we have certain related discipline as well, which includes marketing, production and operation, and human resource management. So this combination of these two decisions, primary decisions or related decisions, are going to support some financial decision areas. Okay. And these financial decision areas may include investment analysis, working capital management, source and cost of funds, determination of capital structure, dividend policy, and analysis of risk and return. Okay. And if we are in the position of taking these decisions properly, okay, we will be able to increase shareholders' wealth. We will be in a position where we may have shareholders' wealth maximization situation. So this is the ultimate aim, why we are managing funds, why financial management is done in any company. So the ultimate aim is to improve the shareholders' wealth. Okay. Now next we will discuss the role of financial manager. Now what is the role of a financial manager? So far we have discussed that what is financial management, what do we understand by financial management, what are the different decisions that we need to take when we are talking about financial management. How financial management is related to other disciplines, be it primary disciplines or other disciplines of management. The next we will talk about role of financial manager. So a financial manager is a person who is actually responsible in a significant way to carry out the financial functions for the company, right? So his role includes raising of funds, allocation of funds, and profit planning. Okay, so firstly, he has to decide that from where he is going to raise the fund. What would be the sources of fund? Whether he is going to raise the funds through equity or he is going to get the funds from debt. At what cost the funds need to be raised. Okay, so these kind of decisions need to be taken care of by financial manager. So once this kind of decision is taken, that what would be the sources of fund, what would be the cost at which the funds needs to be raised, the next step will be the financial manager needs to allocate these funds. That means he has to allocate these funds to the proper investment, proper asset mix. So that will be again our investment decisions. Okay, he will decide that where he need to invest, what would be the capital mix. Okay. Then next will be profit planning. So once the company started giving the profit, the financial manager will decide whether the amount has to be retained within the company and the amount has to be reinvested so that the amount may be utilized for the growth of the company, or the amount has to be distributed amongst the shareholders in the form of dividend. So these were the traditional functions that a financial manager needs to do while he is working for the company. But with time, the role of financial manager is also changing. And now the role of financial manager also includes understanding capital markets. Because now we are not working in certain premises or maybe in one state or maybe in one country. Now the businesses are going global. Okay, so maybe we are already listed in share market, securities market, or maybe in future we are planning to get listed on securities market. So before taking these kind of decision, or even if we are listed, the trading is going on, then also a financial manager need to understand that how capital markets are working so that he can take care of his company based on the situation of capital market. So the role of financial manager doesn't include just the raising of funds, allocation of funds and profit planning, but it also includes understanding of capital market at this moment. So these were about role of financial manager. then a modern financial manager need to answer these questions based on what role he is performing in the company. Like, how should the funds required to be raised? That means it includes raising of funds. That means the sources we need to decide. Okay. And it means actually the financing decisions. Okay. So by taking financing decisions, he may answer this question. Then second one is, in what form should it hold the assets? So what would be the investment where this financial manager need to invest the funds that he has already raised? So that means this question may be answered with the investment decisions. Then the third one is, how large should an enterprise be and how fast should it grow? How big the enterprise is, again, it depends upon your profit planning. Okay, that means your dividend decisions. So a company may decide not to distribute dividend, rather holding the profit or keeping the profit or retaining the profit with themselves and reinvesting the profit for the company so that the amount may be utilized for the purpose of growth of the company. Okay, and how big we have to make our company. It is based on these decisions. These are known as dividend decisions or profit planning decisions. So the third question may be answered with the help of dividend decisions. Okay, so these are the questions that a financial manager need to answer when he is working for the company. Now coming to the financial goals. Okay, why financial management is required? What is the need of financial management? Okay, there was a time when financial management was done with keeping in mind the goal of profit. That means profit maximization. Maximum the profit, good it is for the company. But with time, the role has changed. Okay, now after some time, the focus was shifted from profit maximization to maximizing earning per share. After that, now the mindset of investors are changing. Okay, so is the mindset of financial managers. So this goal of maximizing earning per share is now shifted to maximization of shareholders' wealth. Let us discuss these goals one by one. The first one is profit maximization. The term itself defines that profit maximization means maximizing the rupee income of the firm. Okay, that means we are focusing on increasing the profit of the firm. This is possible when we are using the resources of the firm efficiently. Okay, what is efficiency? It is the output divided by input. So whatever input you are doing, and by giving some standard input, if we are able to increase our output, that means we are able to increase our efficiency. And if we are able to increase the efficiency, the profit will increase for the company. We may use appropriate measures of firm performance. It serves as the interest of the society as well. The goal of profit maximization. Everything was working fine and well. But it was discovered that this goal was actually vague. Why it is called vague? Because it is difficult to define that what kind of profit we are using. Are we using profit after tax for this purpose, for defining the goal of profit maximization, or we are using profit before tax, or gross profit, or net profit? What profit? So different companies are using different type of profits as per their need, as per their requirement. So they are not able to reach to a proper conclusion, or it is difficult to compare the performance of different companies because the parameter that they are using for measuring this particular goal is different. So in that sense, it is said that this method or this goal of profit maximization is vague. And at the same time, it is ignoring the timings. That means it is ignoring the time value of money. See, 100 rupees that I earn today is not equal to 100 rupees that I am going to earn at the end of the year. The value of money, the value of those 100 rupees are different. So this particular goal is ignoring that time value of money. At the same time, it is ignoring the risk level as well. Suppose there are two companies, company A and company B, both are earning equal profit. But for company A, the income is very volatile, very fluctuating. Okay, but at the same time for company B, the income is stable, continuous. So we cannot take or measure the performance of these companies on the same base, keeping the same base. So that is why this goal is also ignoring the risk factor. So that is why it is not at the same time, this goal is not suitable for new businesses. It is not feasible for new businesses, because when the business is starting or the business has started, immediately it will not start giving profit. So how we will measure the efficiency, how we will measure whether we are able to, or we will be able to maximize the profit for our investors or not. So that is why this profit maximization is replaced by maximizing earning per share. Okay. Now, maximizing earning per share implies that the firm should make no dividend payment so long as the fund can be invested at positive rate of return. Okay. Such a policy may not work always. Okay. It may be possible that sometimes this philosophy will work, but it is not always true in all the situations. Because think of the situation of uncertainty. Maybe this rule won't work. Okay. And again, this goal is also, dumped or maybe replaced by the newer goal, because it is also ignoring the time and risk. Okay. But maximizing profit after tax or earning per share does not maximize the economic welfare of the owner. So that is why, again, this goal of maximizing earning per share is replaced by shareholders' wealth maximization. Now, why this goal is important, or why we have reached to this? Because this is the one which is the goal which is considering net present value. What is net present value? That is present value of cash inflow minus present value of cash outflow. So it incorporates time value of money. Okay, so the purpose of the company should be maximizing the net profit value of the company. And since it is considering net present value, it accounts for timing and risk as well. Okay, it maximizing the market value of firm's shares. So that is why now the ultimate goal of financial manager, or for the purpose why we are doing this financial management, is to maximize shareholders' wealth. Then there is need for valuation of this approach, because shareholders' wealth maximization requires different types of valuation models. The financial manager must know that how much should a particular share worth. Okay, remember we have discussed about this understanding of capital markets as a role of financial manager. So he must know that how much should a particular share worth. Upon what factors should this value depend? A financial manager need to understand these things, and we need a valuation approach for this. Okay, so that is why this goal known as maximizing shareholders' wealth is important. Now, before ending today's session, I would like to talk about risk-return trade-off. Okay, so all the discussion will only end with a positive note when we understand this term, that what is risk-return trade-off. What do we understand by this term trade-off? Trade-off means balance. Okay, all the decisions that we have discussed so far, okay, that decisions will lead to positive outcome only when we are able to manage the risk and return, only when we are able to balance the risk and return the company is facing. So financial decisions are guided by this risk-return trade-off. That means they need to maintain the balance between the risk the company is facing and the returns the company is earning. The return and the risk relationship is defined by this equation, which says that total return is equal to risk-free rate plus risk premium. What is risk-free rate? Suppose we are keeping our money in the bank and we are investing in a fixed deposit. We are putting our money in the bank in a fixed deposit and we are getting certain amount in return. So our money is not exposed to risk, but we are getting separated from that money for a particular period of time. So the return that we are getting, because we are getting separated from our money, we are leaving our money to someone else for a particular period of time. So that replacement, that compensation of time is risk-free rate. So suppose we are getting 6% when we are putting our money in a fixed deposit in bank, then that rate, that 6% is our risk-free rate. Okay, because we are not taking risk at this moment. Now, instead of putting this money into fixed deposit, I would like to invest my money in equity shares. Now, when I am investing in equity shares, so I am exposing my investment to some kind of risk, because equity shares, the price of equity shares fluctuate according to the market situation. So in this case, my investment is exposed to risk. Since I am taking this kind of risk, okay, so I may earn some extra amount as compared to what I am supposed to get when I'm putting my money into fixed deposit. So this extra amount that I'm getting for taking risk is known as risk premium. Okay, so risk premium is the result or is the compensation for taking the risk. Okay, so if I'm getting 6% while I'm putting my money into bank as fixed deposit, and I may get suppose 8% or maybe 10% if I'm investing my money into equity market. So that extra 4% is my risk premium. Okay, and combination of these two, that is risk-free rate and risk premium, will make my total return. Okay, so I need to understand that how as a financial manager, I have to make a balance between this risk and return. And this process of making a balance between these two is known as risk-return trade-off. This risk-return trade-off can also be understood with the help of this diagram, where on the x-axis we can see the risk is given, on y-axis the return is given. So you can see the line which is parallel to x-axis, it is showing the risk-free return, because it will remain constant whatever the market condition may be. But the line, the slanting line, the line which is above this parallel line of risk-free return, this shows that risk premium. Okay, and risk premium is increasing when the risk in this particular investment is increasing. And at the same time, expected return is also increasing. Okay, and the combination of these two, risk-free return and risk premium, will give me total return. Right? So this is the diagram which represents the risk-return trade-off. So before ending the session, I would like to conclude today's session. So today we had an overview of financial management. We started the session with the discussion of finance. We understood that what do we understand by this term finance? What is financial management? We have seen the definitions of financial management. We try to understand this term financial management. We have also seen that what is the role of financial manager and what are the goals for which the financial management needs to be done. Okay, the goal of financial management has changed with time. Earlier it was maximizing the profit. Okay, then the goal has shifted from maximizing the profit to maximizing earning per share. And now the focus of financial managers have shifted from profit maximization to maximizing EPS to maximizing the shareholders' worth, shareholders' value or value of shares. Okay, and when you have this kind of goal, this is going to impact our financial decisions. The financial decisions include long-term decisions and short-term decisions. Long-term decisions include investment decisions, financing decisions, and dividend decisions. Okay, so these are long-term decisions, but at the same time, we need to take care of short-term decision as well, which is liquidity management decision, or we call it liquidity decision or working capital decision. So all these 4 decisions comprises of or make a package for a complete financial management decisions. Okay, and these decisions can be taken properly when we are able to make a balance between risk and return, which is known as risk-return trade-off. Okay, so if we read this slide from down to upside, we'll see that if we are able to manage our risk and return, if we are able to trade off between risk and return, we are able to take proper financial decisions. If we are able to take proper financial decisions, we will be in situation of maximizing the value of shares, and if we are able to maximize shareholders' value, the purpose of financial management will be successful. So that is all from my side for the day. Thank you for patience hearing, and happy learning.